Hi there, Dan Ferris, editor of Extreme Value, published by Stansberry Research. And we're celebrating today. It's a big day, March 27th, 2018. Why is it a big day? Well, 18 years ago today, Cisco Systems share price peaked over $80 a share. And I think it was, well, it really was one of the darling internet stocks of the time, if not the darling, and we'll talk about why it might get the number one darling internet stock of the time prize. And then we'll talk about why we're talking about it and why you need to think about this stuff at this time. Okay, so Cisco. Happy anniversary, Cisco. You peaked 18 years ago today at $80.06 a share, according to Bloomberg. And you had a $550 billion market cap, biggest market cap of any company in the world, which only lasted for 2 weeks. It surpassed Microsoft to get that title, and I think GE took over after it fell. 42 times sales, 232 times earnings, 143 times free cash flow. David Tice, a famous short seller of that era, reported that in 2000, Cisco was the darling among the top 10 mutual funds. It was owned in 10 of the top 10 mutual funds, and stocks like GE and AT&T and Microsoft were owned in 7, 8, 9 of the top. Only Cisco was owned in every one of them. It was the no-brainer of the time. And there was a story in Bloomberg and another one in Silicon Valley Business Journal about a guy from Credit Suisse First Boston, I think his name was Weinstein, who said that Cisco would soon have a $1 trillion market cap. That sounds familiar, doesn't it? And of course, the story of Cisco was great. It was started by Lerner and Bossack, I forget their first names after all this time, a couple who fell in love and got married, and they worked in different parts of Stanford University in computer science, and they worked in different computer networks, and they wanted to email love letters, and they couldn't do it, so they put together devices and figured out how to connect their computers, and voila, Cisco was born. And so, great story. And then it was eventually, they hired John Chambers, and there was a great story behind him. The humble beginnings from two doctors in West Virginia were his parents. Raised by two doctors in West Virginia, overcame dyslexia, went to law school, star IBM salesman, et cetera, et cetera. And, the company culture was part of the story too, right? So it was very frugal. Nobody flew coach. All the desks and offices looked the same. Chambers' office was a 12 by 12 cubicle with no window, just like everybody else. And they were very frugal. And they part of the story was their acquisition prowess. They were buying dozens and dozens of companies, and they were very good at it. Yes, they were very good at it. And they integrated the cultures very well. And you see, it was very clever because we overpaid for the company, but we paid less in R&D because we would acquire technology and we would get 10 or 20 great engineers with each acquisition. And so it was a very wonderful strategy, and it worked well. And they had a relentless customer focus, was part of the story that you would hear in all the press reports of the time. And it wasn't just the press. Well, let's just do the customer focus for now. So one of the press reports was that Chambers spent 30 hours a week in meetings with customers, and they were not a dogmatic technology company. It wasn't an insular thing. They didn't care about technology. They cared about customers. So they didn't suffer from not invented here syndrome. They would acquire a technology gladly and get something from wherever they needed it to satisfy a customer. Customer focused, right? And the management team was brilliant. They used technology better than anyone. They could forecast, and they had models, and they could call up, reports that told them where and what they were selling any day of the year, and they could close their books in one day because they knew everything, and they were brilliant with how they used computers to run their business. And they were the envy of every other company in the world. Would love to have reports like that, one of the press reports of the time said. And so, they could do no wrong on the way up. And the press thought so. Individual investors obviously thought so. Professional investors and 10 of top mutual funds thought so. Wall Street analysts thought so. 33 analysts covered the stock in May of 2000. 12 of them had a buy rating. The other 21 had a strong buy rating, of course. And Fortune magazine said, if you could own just one stock, what would it be? Well, it would be Cisco, of course. It's a no-brainer. Everything is going swimmingly, and it will go swimmingly for years, and John Chambers and his team haven't met a challenge they couldn't defeat. And so that was the storytelling of the time. And of course, I mean, there was facts, the facts might have been correct, but the story was wrong. That kind of storytelling always goes wrong. And the same magazine, Cisco and Businessweek especially, if you read The Halo Effect by Phil Rosenzweig, Chapter 2 tells you all about the press reports on Cisco on the way up, and then the exact opposite press reports by the same publications on the way down. It's a great little read, take you 10 minutes. And a year after Cisco praised Chambers the year after Fortune magazine praised Chambers and Cisco, they said that all those things were not just exaggerated or wrong, but they were false. The same magazine, 1 year apart. It's like Nassim Taleb will tell you, if you read newspapers when they're a week old, you'll never read them again because you'll see how wrong everything has turned out. So then what happened? After 43 consecutive quarters of beat and raise, 43 consecutive quarters of beating or matching Wall Street earnings estimates, sales growth went from 70% year over year to minus 30% in 45 days. Just like that, it all turned around. And John Chambers says, our models didn't have this. Our 100-year flood, highly unlikely scenario was minus 5%. And minus 30% actually happened. So the models were worthless. They weren't better with technology. Their models and forecasting weren't any better than anybody else's. And all of them stunk. In fact, actually, some of the other companies were saying, well, we're slowing down with telecom equipment sales right now. But not Cisco. The model said forge ahead. And they wound up writing off $2.25 billion of excess inventory and firing 8,500 people and seeing the sales drop 30% year over year. So, this is a cautionary tale. This, and the $1 trillion market cap story was right at the peak. And we see the same thing today. There are $1 trillion market cap stories that are a month or two old here about, Amazon, Apple, Google, all the big names of today. Microsoft was in one of them. And it's just the kind of thing that people talk about when all they're thinking about is where the share price is going to go next. It's the kind of human foible, right? It's a rose-colored glasses problem, right? When you look at the world through rose-colored glasses, all the red flags just look like flags, and everything looks like one. It's wonderful. So today, what are we making these mistakes with? Facebook, Google, Amazon. Nobody thinks Jeff Bezos can do wrong, right? It's like John Kenneth Galbraith in his short history of financial euphoria. It's the specious association of money with intelligence. These guys are rich because they're geniuses and they know more about how the world works than you do. That may even be true, but when you pay 33 times all the profit they've ever made since their founding, they better never make the tiniest mistake. That's where Amazon is today. So, Google, Facebook. I mean, if Facebook can have the kind of problems it's having, why can't Google have the same problems? Facebook is having problems because they gathered up a bunch of data and used it in a way they said they wouldn't use it. And they're being called to testify in front of Congress, and the stock is down, well, as much as 20%. And I was telling people last September, you're lack imagination if you don't think these stocks can drop 20, 30% very quickly. And that's exactly what has happened. And it can still happen even more. It can happen with Google. It can happen with Amazon. All of them. NVIDIA, 15 times sales. Scott McNealy from Sun Microsystems told the story in 2002. He couldn't tell it at the top because he had fiduciary responsibility. He was the CEO of Sun Microsystems. He said, what were you thinking paying 10 times sales? You didn't need regulators to get involved. You just needed to not be an idiot. What were you thinking? At 10 times sales, you got to pay out 100% of sales for 10 years to get your money back. And 15 times sales, 15 years. That means, no expenses, no capex, no taxes. you know, it's just not going to happen. It's an impossibility. When you're paying these kind of prices, you're paying for everything to go perfectly for 2 decades. And Cisco didn't go perfectly, and the stock is what, 40 something plus dividends. It's still below, they paid $5 in dividends throughout this period, and it's still below 50 if you add those two numbers together, and it peaked at 80. Almost 2 decades, you still haven't broken even. And you still haven't broken even on AT&T, you still haven't broken even on GE from the peak in 2000. I think it took about 13 years 14 years, something like that, for Coca-Cola to break even. Took 16 or 17 for Microsoft to break even. You get the picture. It doesn't matter if it's the greatest business in the world. It doesn't matter if Jeff Bezos has taken over everything. It matters how much you pay. It matters how much optimism is already baked in. And I promise you, at 33 times all the profits they've ever made, lots of optimism is baked in. And that's where we are today. And man, people are going to get destroyed. People are going to lose 20, 30, 40, 50%. They lost 20% just like that in Facebook. Oh my gosh. When they were paying $195 for Facebook in February, I promise you, nobody was saying, this thing could lose 20% really fast. They weren't thinking that. They were thinking this company can do no wrong. It's the greatest business in the history of everything. It's more popular than communism and Catholicism. And, it's got 2 billion people actively using every month. It's the biggest thing in human history. That's all they're focused on, how wonderful it is. It gushes cash. CapEx is low. Free cash flow is high. They can do no wrong. And that kind of thinking will get you into trouble. You have to think in a more measured way about investing. And you have to think about the price you pay. And that's really the message for today. People aren't thinking about the price they're paying. They're thinking about how wonderful these businesses are and not caring at all about the price. And of course, we see ETFs are basically price insensitive algorithms that the algorithm is buy. That's the algorithm. We get $1 of capital into the fund, buy. That's the algorithm. And something that doesn't have selling as part of the algorithm, there could be a problem there eventually. And, these problems, they hit you pretty hard when they hit you. It's like the VIX sellers, the VIX short funds doubled in about 2 weeks last August, and one of them went out of business virtually overnight, just recently. So it's the Thanksgiving turkey problem. Ooh, I'm fat and happy. The Thanksgiving turkey is very happy. He's being fed. He's kept comfortable. He's protected from the wolves. He feels great. He gets fatter and happier every day, and then he gets his head cut off and he gets eaten for dinner, and that's unfortunately, that's what the put sellers are looking at. That's what the VIX sellers are looking at. And that's what people who pay 33 times all the profit that the business has ever earned are looking at. And that's what people who pay a price that assumes that they'll never make a mistake and never not be the greatest business in the world are looking at. So, wow. It's a pretty exciting thing to me, obviously. I hope it's as interesting to you. And be careful out there. Hold plenty of cash. Only buy stocks when you get a substantial margin of safety. We found 3 really awesome deals recently in extreme value. Stuff that trades at 1 and 2 times the peak cash flows, and has cash gushing assets and low capital requirements and all kinds of good aspects to them. Brilliant management teams. Just really great dividend payers. We found one of them, one of those 3. And just stuff with a great margin of safety at cyclical lows, run by good management teams, and you're not paying up at all. So you're getting them dirt cheap, in fact. So, that's what I encourage you to look for. And I also encourage you to hold plenty of cash. And we talk about short selling sometimes too, but that's not as important. It's more important to not overpay and not look at the world through rose-colored glasses, and not to have all the red flags looking just like flags. So on that note, happy Cisco peak anniversary day, and I will talk to you guys next time. And thanks. I really appreciate each and every one of you. I'm very grateful for my audience, modest as it is. I'm really grateful, and I hope to talk to you again soon. I promise I will talk to you again soon. And thanks for tuning in. Bye.